Hi everyone, in this video I'm going to go through Fiverr's most recent quarterly conference call the CEO and CFO held with Wall Street analysts to try and decipher what's going on with Fiverr's stock. Of course, the online gig economy platform benefited from a tremendous surge in signups both from the supply side and the buyer demand side during the pandemic as most people looked to working remotely and got used to performing work remotely and had home offices. So let's see how the business is holding up, starting with the CEO and founder Micah Kaufman, highlighting that their decision a few months ago to optimize their cost structure and accelerate our pace towards long-term margin target is also paying off. Of course, if you've been following tech stocks more recently, you've been noticing a lot of announcements of layoffs and hiring pauses. Fiverr was ahead of the game here. They started their pausing and cost reductions in June, July time frame, and so they're getting the benefits of it right now, as per what the CEO just said right here. So moving on, um, we operate a global market base where millions of buyers purchase digital services from our platform across over 550 categories. This allowed us to detect the shifting macro conditions as early as March. We took a step ahead and even accelerated our pace of improving the bottom line when growth became more expensive. Interesting. So, because of the nature of the services that they offer, they detected a slowdown coming as early as March, and they were able to take action ahead of time before, most more recently tech companies have been taking action. They took actions a little earlier and rebalanced their cost structure. We believe maintaining a healthy cash flow and cash balance. This is important for investors when you're looking at what kind of company to invest in. Fiverr is telling you that they're going to be a healthy cash flow and cash balance company. They're not going to be one of these tech stocks that just goes after growth at all costs, regardless of how it's impacting its cash flows and profit margins. I tend to prefer these types of more prudent management teams rather than those growth at all cost management teams that just look at growing their top line without considering how it's impacting their cash flows and how negative cash flows are and how negative profitability is. Moving on, according to our latest annual Freelance Economic Impact Report, U.S. independent professionals earned a total of $247 billion in 2021. Contractors, in other words, earned $247 billion in 2021. To quantify this further, according to a recent survey by McKinsey, 36% of the American workforce makes their living through independent work, which is a considerable increase from 27% back in 2016. So uh, uh, let's say a 33% increase in the amount of people that are independent contractors since 2016. And I suspect that trend to continue in that direction. Working as a contractor is favored by many workers because of the freedom it provides. Many people, many professionals built out their home offices during the earlier stages of the pandemic. So now they're looking to capitalize on that, and they got accustomed to working from home and not having to commute and saving a lot of time in that regard, working in the comfort of their homes. And so this is something that they've said that they liked. And now that corporations are starting to ask workers to come back to the office, some workers are saying, you know what, forget that. I'm not coming back to the office. I'll just go off on my own. Instead, we have these platforms like Fiverr, like Upwork, where they can go and earn a living without having to commute to an office 4 or 5 days a week. We looked into the industry hiring trends around the last economic cycle and noticed that during the economic downturn, freelance demand gets hit first before full time hiring and oftentimes leads broader GDP trends. That said, freelance demand is also expected to be the first to recover as we climb out of the downturn, and the rebound is typically bigger in magnitude compared to full time employment. That's interesting. So, This industry, the gig industry, got hit first before the layoffs in other areas, right? As the company mentioned earlier. But they also expect that when it rebounds, according to historical trends, that the gig economy is going to rebound faster than the overall economy. So that's interesting. If you're expecting a deeper economic recession, the gig economy has already felt the impacts of it, and then when the economic recovery happens, the gig industry will recover faster and sooner than the overall economic industry will. So active buyers were 4.2 million, nearly double what we had 3 years ago. Spend per buyer grew over 60% and take rate grew 340%. So they've made incredible progress over the last 3 years. As I mentioned earlier, the pandemic was a boom to the business, and they've managed to maintain most of that growth that they experienced. Now, growth has slowed down, but it hasn't turned very negative. All right, now on to the CFO, Ofer Katz, talking about revenue of 82 million, came in at the top end of their guidance, growing 11% quarter year over year. That's solid. And active buyers were 4.2 million, up 3% year over year. So solid. Even as the macroeconomic headwinds hit the company, they're still managing growth. They're still managing to sustain the growth that they achieved during the earlier stages of the pandemic. So this is all good news. The average number of spending per buyer in Q3 was $262, which is up 12% year over year. The number of buyers that spend over $10,000 annually grew 50%. The take rate in the quarter was 30%, representing an expansion of 160 basis points. So that's really good. The take rate of 30% is on the higher end of a lot of these platform companies that I follow. I follow eBay, Etsy, Uber, Lyft, and many other of these platform companies that take a percentage of the transaction value, and 30% is on the higher end. So if they're able to maintain this, sustain this level, that's really good. That shows their pricing power that they can achieve in the industry. And here's their outlook for the fourth quarter of 2022. Revenue is expected between 79.8 and 85.8 million, representing year-over-year growth of between 0 and 8%. So something positive, right? Let's say 4% at the midpoint they're expecting. And then I will end with their 2022 guidance for the full year 2022. They expect revenue of 334 million to 340 million, representing growth at the midpoint of 13%. So solid growth for the company for the year, even amid industry headwinds, even amid the slowdown in their cost structure in becoming more disciplined in investments in growth. So all in all, the results are to be expected for investors, and investors can feel good about the steps that management is taking to kind of get more prudent financial management amid higher cost of capital, higher cost for growth. So good news here for Fiverr international investors. Even though the stock has been hammered, management is taking reasonable steps to account for that slowdown in growth. All right, that's all I've got for this video. Thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.